Hello, this is Rochelle Agatha, and this is the lecture for Chapter 3, which is on job costing. The first objective is to distinguish between job costing and process costing. Process costing is mass production for similar items. Total costs are averaged over all units, and some examples are paint manufacturers, oil refineries, cereal manufacturers. Notice that the type of product is very process driven. Job costing is for unique custom products or small batches. The total costs are accumulated by job. Examples are hospitals, custom home builders, advertising agencies. There's all kinds of job costing examples out there in the world. So let's do the first example in your book. So if you look at S31, it asks you to define if it's process or job costing for these different examples. So a manufacturer of fiberglass insulation seems like a big thing, like a lot of mass production, so it's process costing. A residential plumbing contractor would be a job costing. A manufacturer of fiber optical cable would be process costing. Custom home builder, job, and a hospital would be job. So this gives you a little example of what we're talking about. So for objective 2 is understanding the flow of production and how direct materials and direct labor are traced to jobs. So let's watch the flow of inventory through a manufacturing system. And this should be a little bit of an overview because we talked about this somewhat in previous chapters. Raw materials become work in process, which become finished goods, and then they're sold and it becomes cost of goods sold. So here's an exhibit of production schedule for the month of December. So this is an example out of your book where you're talking about fitness equipment. And here's some different jobs of what they're building. And it shows you a schedule of when it's supposed to start and when it's supposed to end. So this is a production schedule. And then you need your bill of materials. So for each part number, here's your description and here's the quantity that you need. So when you talk about job costing, you need a schedule of manufacturing and then what's needed for each product. Purchasing process is purchasing determines the order of the needs. Purchasing issues the purchase order, and shipping and receiving prepares receiving report. This is very similar to financial accounting, so this should sound familiar to you when we talked about purchase process in Accounting 201. Then accounting matches the invoice with the purchase order, and then accounting pays the invoice. So this is your typical voucher type situation. But for job costing, there's a job cost record outside of the financial accounting GL system where it shows you the item. And remember, this is all computerized in the world today, but it looks you need to learn it like it used to be done on paper for it to make sense. So here's your cross trainer, and here's your cost summary, and you're going to make 50 units. So this is a job cost record, whether it's computerized or not. And then here's your work in process inventory. So all the jobs are in process at some point, and then they sit on the balance sheet in that work in process line item. So when you look at a GL of a manufacturer, in that work in process inventory is a whole separate job cost system behind it. The materials requisition is the part and the description, the quantity and the cost and the amount of what was ultimately used in that requisition. And then this exhibit shows raw materials record updated for materials received and used. So now you have the actual product, like the heart rate monitor, and you see how many units you received, the cost, the total, what you used, and then the balance. So this is like an inventory record for the raw material for this product. So that's what this is showing here. Then you need to track your labor. So here is direct labor costs, which are traced to individual jobs. So when you're job costing, I hope you're starting to see it's very complex behind the scenes. If you're really going to track job costing, you need to track all the pieces of it, of which is labor. So here they're showing that this person, Hannah Smith, for this week worked on these jobs for this much time and it cost this much. Why is this important? Because her labor is going to be charged to those different jobs, and it's really important to get the right cost in the right job, or you'll never know if the profit of the product is true or not. So now you post everything back to the job cost record. So here was the direct materials, here was the direct labor, and that's as far as we've gotten at this point. So we've got direct materials and direct labor for this elliptical cross trainer. Okay, objective 3 is to compute the predetermined manufacturing overhead rate. You're going to start seeing this class. It might be good to keep flashcards with all these little acronyms, just so you can flip through them and you don't have to look back in your PowerPoints. So this predetermined manufacturing overhead rate is the total estimated manufacturing overhead cost divided by the total estimated amount of allocation base. Wow, that's a mouthful. So let's do an example here. You're allocating manufacturing overhead to individual jobs. So to do that, you take your predetermined manufacturing overhead rate times your amount of cost allocation activity used. So here's an example. You had total estimated manufacturing overhead of $1 million. Where did that come from? That comes from your typical budgeting and from you doing this for a long time and knowing what manufacturing overhead estimates are. So it is an estimate, and it's based on trends and historical back jobs, etc. You have your cost allocation base is your direct labor hours, and then your total estimated direct labor hours for the year are 62,500, and this is the job. So, and it says it used 500 direct labor hours. Okay, so there's your data. So to calculate it, you take your $1 million and divide it by your 62,500 direct labor hours, because that's your base, and you get $16 per direct labor hour. So stepping back and looking at this, what this is saying is that you're taking your predetermined manufacturing overhead and you're using direct labor hours as your base. So you're going to use $16 per direct labor hour as an allocation for predetermined manufacturing overhead. So now let's allocate it to a job. So here you have your $16 times your 500 DLHs, which was on the slide above, and you get $8,000. So now you have your direct materials, your direct labor, and your manufacturing overhead, which was based on that calculation to get the 16 times the actual direct labor hours. So now you're starting to see that job costing uses a lot of estimates, and it is very important that the accountants that do this are good at what they do, they pay attention, and they really have an understanding of the business, because this number could throw off your cost per unit a great deal if you miscalculated the estimate that you used to draw the $16 from. When is manufacturing overhead allocated? Okay, here was the slide we learned in a previous chapter that all the direct costs go into work in progress, and then you have your finished goods and your cost of goods sold. So you must take the direct materials and direct labor and the manufacturing overhead, and then that goes into work in process. Then you go to finished goods, and then your cost of goods sold. Notice I say work in progress a lot instead of work in process. It's just terminology. They mean the same thing. Objective 4 is to determine the cost of goods sold. So the reasons why management needs product cost. Well, you want to reduce future job costs. You want to assess and compare profitability of models. You assess for pricing decisions, discounts on high volume sales, bids for custom orders, financial statement preparation. These are reasons why management needs product cost. They can't make decisions without it. So you are now the managerial accountant. You're not the GL accountant. And so it's really important to understand why management is asking for this information. Sustainability in job costing is based on a job cost record must capture the essential resources required to manufacture a product. If your job costing information is wrong, you're going to have your management will make wrong decisions. A job cost record can be enhanced with information about the all these different things: future consumers, future disposal, employees involved in the manufacturing process. All this stuff is really important. Where do you think all this information is kept? Because it's not kept in the GL. It's kept in separate records. So whether it's manual or it's in a computer, a job costing computer system, etc., you have to keep really good records for job costing. Let's move on. Let's look at E318A. So this one says, what is Raymond's predetermined manufacturing overhead? He had total direct labor costs of $770,000. So he had his, and you need to look at the problem in the book so you can get the numerator and the denominator figured out. His predetermined manufacturing overhead rate is therefore the $485 divided by the 770. So look in your book, and we'll follow along as we're going through it. That comes up to be 63% of direct labor cost. Remember, this number here is that estimate. Then the problem says, calculate the manufacturing overhead to be allocated based on the direct labor cost to job 371. So if you're looking in your book, they have given you information about job 371. They gave you direct materials used and direct labor hours. So they gave you the direct labor hours used of 180. So you're going to times that by the 35 that you calculated previously, and you get 6,300 direct labor cost. So if you take 63% times $6,300, that's $3,969. The allocated manufacturing overhead then for job 371 is $3,969. Job costing uses a lot of allocations, so it's very important that this 63% is pretty accurate because you're allocating based on that. What is the total cost of job 371? It was the direct materials used, the direct labor cost, and then this allocation. So now you have this total cost for the job of $24,769. If you've miscalculated any of these buckets, your profit on this job or loss will be dependent on that. Objective 5 is compute and dispose of allocated or under-allocated manufacturing. So this is what happens when you're not right, because nobody's perfect. No allocation or estimate is perfect. So let's talk about FedCorp. This is just an example where they give you the projected manufacturing overhead to be $200,000 and the estimated direct labor is $140,000. What is FedCorp's predetermined manufacturing overhead rate? So here you take the $200,000 divided by the $10,000 is $20 per direct labor hour. FedCorp's actual manufacturing overhead for the one ended up being $190,000. So a total of 11,000 of direct labor hours were worked. Using the predetermined manufacturing overhead rate of 20, how much overhead was allocated to all of FedCorp's jobs during the year? Okay, you took the 20 times the 11,000 is 220. Okay, so see this right here on the next slide. You're going to say, how do you actually look at that? We're continuing on with FedCorp to look at the estimate versus the actual. FedCorp's actual overhead and their allocated overhead were different. There was the 190 and then there was the 220, and that was what the allocation was. So you have a variance of $30,000. Okay, so you're thinking, what does that really mean? The target was 190. They actually allocated 220, so they over allocated $30,000. Just think about basic budgeting skills. You estimated 190. It ended up being 220, so you over allocated $30,000 to this job. Under allocated is under costed. Not enough allocated to the jobs, too little expense. Over allocated is over costing, like this example. Too much allocated to the jobs, too much expense. So this isn't good when you over allocate. Why? How? How does this happen? Well, the estimated manufacturing overhead costs were higher or lower than actual. And this is where I was talking about on the previous slide. It's really important for the managerial accountants to have that understanding of the business. You probably used more or less of the estimate allocation base than projected in reality. So you projected you were going to use this base and you ended up using less. So you have two solutions. You can adjust the cost of goods sold, or you can prorate between cost of goods sold, work in process, your inventory, and your finished goods, because you have to do something at that point. How do manufacturers treat non-manufacturing cost? Well, GAAP only allows inventoriable product cost to be added to the cost of the asset. Internal decision making, management wants to know the total cost of the product across the value chain. So internal decision making versus GAAP. Let's look at E3-24A, which is in your book. Requirement 1 said predetermined manufacturing overhead rate, and they give you the information. They give you the 650, and then they give you the machine hour. So you have $8 per machine hour if you're following along. Requirement number 2 said, what's the allocated manufacturing overhead? And you look back into the problem and you look at all the information. You had 54,500 machine hours times $8 per machine hour gives you $436,000 of allocated manufacturing overhead. Requirement 3 wants you to figure out how much manufacturing overhead was incurred during the year. So you have depreciation on plant and equipment, property taxes on plant janitor's wages, gives you total manufacturing overhead. Because remember, manufacturing cost is related to the manufacturing part of what you're doing. And that was $517,500. Requirement number 4 is asking you, were the jobs overcosted or undercosted? By how much? Okay, you had actual manufacturing overhead of $517 from the previous requirement. Allocated manufacturing overhead was $436 from a requirement previous, giving you an underallocated manufacturing overhead of $81,500 because this number is less than the actual. Prepare the journal entries for the manufacturer's job costing system. So now we're going to be like regular financial accountants, and the management accountant would help prepare this journal entry and give it to the financial accountants to book. The raw material inventory, let's say, is $90,000, so it goes a debit to raw materials inventory, credit to accounts payable. Work in process inventory and raw materials, that's what moved from raw materials into work in progress. And then you had manufacturing overhead that needed to be debited against raw materials inventory. This is to record the use of the indirect materials in the factory. Then you have wages payable for all the people that were paid into the work in process inventory based on all those little job cards we showed earlier as people track their time against jobs. And then you need to record the use of indirect labor. So this is the manufacturing overhead labor that gets put from wages payable into manufacturing overhead. And these accounts here, these look very familiar from a financial accounting standpoint. These are your new accounts from this being in managerial accounting. So now you have your manufacturing overhead. You have accounts payable for some electrical bill, accumulated depreciation on plant and equipment, prepaid plant insurance, property taxes on the plant, etc. So these are all the things that you need to credit that are going to come debit out of manufacturing overhead. This is to record other indirect manufacturing costs during the month. So now let's talk about allocating the manufacturing overhead to jobs. So you had your $16 per direct labor hour times your 500 direct labor hours was $8,000, and then you had another job. So you had 2 jobs. Those are actually taken out of the manufacturing overhead and allocated to the work in process for specific jobs. Okay, so now you're doing a specific job allocation. Completion of the jobs. Once the job is done, these treadmills are done now. You have your direct materials, your direct labor, your manufacturing overhead, and then you have the number of units. So it was cost per unit of 1,800. So you're going to move from work in progress into finished goods, that 108,000, based on the number of units that you, the cost you had for those units that are finished. Then when you sell them, if your sales revenue comes in at the price that you sell them for, so you sold 40 at $1,425 and 60 of them at $2,500. So you recorded the 40 cross trainers and 60 treadmills. The cost of goods sold was the cost. So there's the 60 at the 1,800 and you had 40 of these right there. So notice that your cost is less than your sales, so that's a good thing. So this is to reduce your finished good inventory and record your cost of goods sold. The operating expense come in based on all the different things that happen throughout the month, your marketing, your rent, your salaries. These are all non-manufacturing costs, typical financial accounting. Then you close your manufacturing overhead. So whatever's left goes into the cost of goods sold. Now you have a little income statement for the Life Fitness. There's your sales revenue less your cost of goods sold is your gross profit, less your operating expense is your operating income. This is Exhibit 318 in your book. Let's go over an Objective 7 real quick because it talks about service firms. Job costing is done in service-related entities, and think of other entities too, other than what I'm going to list here. It's similar to job costing of a manufacturer, but healthcare, hospitals, those kinds of businesses do job costing for service lines like transplant services or cardiac services. So job costing is important outside of just manufacturing. The main difference is that the company has allocated indirect period cost to each client rather than manufacturing cost, or to each service line rather than a manufacturer, than a type of thing you're manufacturing. There's no inventory, so there is no journal entries. It's truly a cost accounting system that resides outside of the GL. And there's 4 steps. Estimate the total indirect costs for the coming year. Choose an allocation base and estimate the total amount that will be used during the year. Compute the predetermined indirect cost allocation rate and allocate indirect costs to client jobs using the predetermined rate. So job cost plus markup for profit equals the amount that you would bill a client. And if similar situation in a hospital service line, you would have the cost of the service less any markup for profit is the amount that you bill. So here's an example of S3-12. There were hourly direct labor cost rate of $140,000 with 2,000 hours is $70 per hour. So if you had 21 hours times 70, it would be $1,470 for client 367. And if you had an indirect cost allocation rate, was your total divided by your 26,000 hours is a $15 rate. So you're going to allocate that out. So you're going to get $315. So you have your direct labor, your indirect cost is your total job cost. And that's the end of the chapter. There is a lot in this chapter, so please go back and do all the problems in the book that are in there as help. And if you have any questions, send an email. Thank you.